Ohio's most trusted commercial real estate advisors. Perfect Real Estate Investments presents
Understanding income from your investment property. To understand income from investment properties, let us first look at the types of rents and leases. Not all properties have the same kind of rents. When you buy an investment property, it is important to understand the type of rent the tenant is paying. Contract rent is the actual amount of rent a property is earning as specified in a lease. On the other hand, anticipated rent is the rent a buyer anticipates when he purchases a property. This may, or may not, be the same as the contract rent and/or the market rent. So what is market rent? Market rent is the amount of rental income that could be expected from a property if available for rent on the open market. Percentage rent is the amount of rental income paid by some retail stores and restaurant tenants that is based on a percentage of their sales, usually with a guaranteed minimum rent. When additional rent is paid under a percentage rent lease that is over and above the guaranteed minimum rent, it is called overage rent. When the contracted rent exceeds the current market rent, it is called excess or surplus rent. Now let us look at the different lease types. You will hear different terms when you look at commercial leases. You will see terms like gross, modified gross or MG, net, triple net or NNN, and absolute net. But most of these fall under three broad categories. The first kind of lease is under which the landlord receives stipulated rent and is obligated to pay all or most of the property's operating expenses and real estate taxes. This type of lease is called fixed expenses lease. A variable expenses lease is where the tenant pays all property operating expenses in addition to the stipulated rent. Under a triple net or net lease, the lessee or the tenant assumes all expenses of operating a property, including both fixed and variable expenses. The type of lease and the rent the property is getting will help you determine what kind of income stream that property generates. Let us now look at the different kinds of income streams. A constant perpetual income stream, a series of equal, annual incomes that flow into perpetuity. In theory, land is a non-wasting asset and is capable of producing a constant perpetual income. A constant terminal income stream, a series of equal, annual incomes that terminate at some point in the future. This is true for most investment properties, especially single-tenant properties where the lease ends at some point. Variable income stream. A variable income stream is a series of annual incomes that fluctuate in amounts from year to year. This is true for multi-tenant properties as well as retail and restaurant properties that have a percentage lease. And finally, a single income payment, also known as reversion. A lump sum payment the investor will receive at some point in time in the future. This applies to fix and flip properties. Investors anticipate that the future income from the property will satisfy several different functions. Therefore, the income stream can be separated into several components. A portion to provide for all property-related expenses, including vacancy and collection losses, maintenance and repair, and utilities. A portion to provide for the payment of the property taxes on the property. A portion to allow for the return of the investment, and a portion to allow for a return on the investment, even if this return on or yield is not realized until the property is resold. Let us look at each of these components in detail. Vacancy and collection loss. As an investor, you should anticipate that the property will experience some vacancy or collection losses. Even when a property has a history of no vacancy and collection losses, it is prudent for an investor to anticipate that a loss will occur at some point in the future. Banks normally take this into account when underwriting the loan. Vacancy and rent collection loss is an allowance for reductions in gross income attributable to vacancies, tenant turnover, and non-payment of rent. Vacancy and collection losses are usually expressed as a percentage of potential gross income. It is normally calculated at 5% of gross income. Property expenses. As an investor, you should also anticipate that the rental income should be sufficient to allow for all property-related expenses. Operating expenses can be classified into three broad categories. Fixed expenses such as insurance and taxes. Variable expenses such as management, maintenance, repairs, and utilities. And reserves for replacement of the roof, equipment, and paint. Usually you will replace major items periodically during the life of the building. Return of investment. As an investor, you should expect that the income stream should allow for a return of your investment. Return of investment is the recovery of invested capital, usually through rent payments and eventual sale of the property. The return of investment is also called recapture of the investment or capital recapture. Allowance for recapture can be accounted for in a variety of methods: sinking fund recapture, straight-line recapture, or sale of the property. The return on the investment is the additional amount received as compensation for use of your capital until it is recaptured. Generally speaking, an investor will not invest in property that will not produce a return on the investment. Would you? This concludes our presentation. Thank you for watching. If you have any questions or need more information, call PRE at 614-450-2510 or visit our website perfectrealestateinvestments.com.